All right, everybody. Thanks for attending this month's webinar. This month we're going to talk a little bit about how should you position your portfolio today. I'm going to talk a little bit about what I'm doing for my clients, and you may agree or disagree. But for the latest portfolio moves, I'm looking at a couple different trends. One, I think bond yields will remain steady or possibly even go down a little bit. I do think that the increase we saw in bond yields last year is now over and will be that way for a while, and I'll explain exactly why I think that. So since I think bond yields will remain steady or go down, I'm looking at higher yielding interest rate sensitive assets. Obviously, if rates hold steady, these things tend to do a lot better. I'm also going to talk a little bit about how can we find value in stocks. That's one of the big things we'll talk about. And then hedging against a potential stock market decline here in the US. These are the moves I'm making for clients. And let's jump right into bond yields. So from July 2012 until really last fall, we saw rates go up, and it got really brutal from May through June of 2013. So if you go back historically over the past 50 years, we've seen 17 occurrences where we've had bond yields go up by roughly 40% or more. And this chart will show you all 17 cycles, including the most recent one. Along the x-axis, it shows you the days it took, and then along the y-axis, it shows you how much treasuries went up in yield. So if you see this chart, the move from July 2012 to the present was the largest move in a short period of all 17 cycles. It went up 115% treasury yields. Now, a lot of people argue that yields were so low that they had to move up, and they'll still argue that yields are still historically low. So we could see a further increase from here, but history doesn't prove that out. So if we go back and look at the other 16 cycles where yields went up considerably over a short period of time, you'll find that every one of those 16 actually saw rates decline after, and the average drawdown was about 35%. So rates went down about a third on average after you've had a big move to the upside. So unless this 17th cycle, the one we just went through, is a historical anomaly, we should see rates at least stay steady, probably go down. The other thing is I think there's a longer term historical metric taking place, historical trend. Every time we've had a banking crisis, a credit crisis, you've seen rates go down considerably and stay there much longer than most people think they would. This chart shows you the US in 1873 and US in 1929. Both of those had bad credit crisis. It also shows Japan in 1989. And what you can see here is not only did rates decline, but they stayed low for over 20 years. So the banking crisis we had in 2008, we're only 6 years past that. Rates have actually come down, but if history holds, we could see rates decline even further and stay at this low level for another 14, 15 years. So how do you play this? How do you invest? Well, if interest rates kind of stay where they're at, then you want to step out and take longer dated maturities in bonds. Some things I've done for clients, I've used the iShares 20-year Treasury, ticker symbol's TLT. Now this is a very volatile holding, but if rates stay where they're at or come down, this tends to do pretty well. Another holding is a Vanguard intermediate total bond market, BND. So this is going to be more intermediate, between 5 and 8 years in duration, but high quality stuff. I'm also using real estate investment trust, or REITs. Now REITs always pay a pretty good dividend because they have to distribute by law 90% of their income to investors. The REIT that I use is the Vanguard ETF, ticker VNQ. Another REIT that I'm focusing on is mortgage-backed REITs. Now, mortgage REITs are very interest rate sensitive. The reason is not only you're investing in mortgages, but these vehicles add leverage. So they borrow money to invest in more mortgages. So what this does is it increases the risk, but it makes it extremely sensitive to interest rates. However, right now, the yield on most of these is between 12 and 14%. I use the iShare ETF for mortgage REITs, ticker symbol REM, and it's got a yield of just over 13% right now. Another holding I'm using quite a bit for clients are master limited partnerships. These, again, are very interest rate sensitive. And much like the REIT, the master limited partnership has to, by law, distribute 90% of its profits to the shareholders. Master limited partnerships are kind of a commodity play, but they're not tied to the price of commodities. A lot of these are dealing with the infrastructure. So you have a lot of shipping companies, railway companies, and pipeline companies. Again, the yield on these are pretty good, close to 6%. And here's the ticker symbols for two that I use, the Yorkville High Income, YMLI, and the Illyrian Master Limited Partnership Index, AMLP. So you might want to add some of that to your portfolio. I'm doing that for clients. Now, finding value in stock market is really difficult, especially if you look at the U.S. market. I use several valuation metrics to determine if things are expensive or if they're cheap. The one I like the most is called the CAPE. It stands for Cyclically Adjusted Price to Earnings. Now, price to earnings is a pretty simple concept. You can look at it for an individual stock. Let's say you're going to buy Disney, and it's at $40 a share. And for each share, it has $4 of earnings. So all you do is you take $40, divide it by $4 per share earnings, and you get a P&E of 10. Now, you can do that in an aggregate for the stock market overall. But it kind of shows you how simple the price to earnings is. Now, the cyclically adjusted price to earnings is a little bit different. It was developed by Robert Shiller, who won the Nobel Prize in economics for this last year. He takes the earnings over the past 10 years and adjusts it for inflation. What this does is it takes a very volatile figure, which is earnings, and it smooths it out over time. And what he found is you can look at the CAPE of various stocks or stock markets at the beginning of the year, and you can use this kind of a predictor for intermediate to longer term returns. It doesn't tell you too much in the short term, the 1 or 2 year period, but it is a great indicator when you look at 5 or 10 years. So what this chart shows you is if you had a PE below 5, all the way to PE as high as 50. When we have single-digit PEs, you do see a 1 year return of between 14 to 25%. But more importantly, you see a 10-year annualized return between 10 and 15%. Not too bad. As the price to earnings goes up, you can see that the yield or the return goes down. So right now, the U.S. stock market is at 25 P&E based on the CAPE. So typically, historically, when we've had that high of a valuation, the 1 year return has been 1.3%. The 5 year has actually been a negative annualized return of negative 1.3. And the 10-year return is pretty low at 3.3% annualized. So here again, if you're investing in U.S. stocks, if this historical metric holds as it has in the past, the forward 10-year return on stocks in the U.S. probably isn't going to be too good. So you need to find value elsewhere. And you can. Every stock market has a different valuation. Usually when you have a low CAPE value, it's going to be in a country that's had some financial struggles. The market punishes countries or companies that have had trouble, but that's a very good time to buy in because you're getting the earnings at a lower rate. And to kind of put it in perspective, a price to earnings, if you have a P&E of 10 like we did in that Disney example, what that's telling you is at $4 per share earnings and a price to 40, you pay $40, and it's going to take you roughly 10 years to get your initial $40 back. So obviously, the lower the price to earnings, the better it is for you as an investor. So this was put out by Meb Faber of Cambria Asset Management, and what he did is he took the 10 cheapest countries, the 10 lowest CAPE values, and the 10 most expensive for 2013. And you can see the returns for 2013. For the lowest 10, they returned 21% last year, which, hey, that's not too shabby. Whereas the 10 most expensive had a return of negative 5%. Now, for both the cheap and the expensive, we had outliers. So Russia was an outlier for the inexpensive capes, it had a return of just under 1%, whereas the U.S. was the outlier last year. It started off with a cape P&E of 21, but it got much more expensive with a return of 33%. Now the P&E is at 25. So again, it doesn't tell you anything on the short term, but it does tell you something more on the long term. So here's just another way to look at expected returns for countries that are in the developed world. So this is Eastern Europe, or I'm sorry, this is Western Europe, the US, and Japan, Australia, New Zealand. And what you can kind of see here is along the y-axis is the expected return in percentages over the next 5 years. Along the x-axis, you have the potential drawdown over the next 5 years. So the US could expect, if history holds, a drawdown of about 25% in its stock market. Over the next 5 years, though, the annualized return really is going to be a low single digits. Ireland's even worse. But if you look at a lot of the countries like France, Japan, New Zealand, Australia, Singapore, Hong Kong, these countries really, you're looking maybe a drawdown of 10 to 15%, but annualized returns between 7 and 11%. Not too bad. Much more value there. This is the same chart, but it looks at the capes for emerging markets. So these are countries like China, Brazil, Russia, Eastern European, South American countries. There are a few like Korea, Thailand, and the Philippines, which have very expensive markets. They're expected to have low single-digit returns over the next 5 years. The Philippines even expected to have a negative return, but they're also expected to have drawdowns over the next 5 years of greater than 30%. Whereas some countries in the emerging markets, you're looking at maybe drawdowns between 10 to 20%, but you're looking at annualized returns of 8 to 10%. Much better valuations. So what am I doing for clients? Well, what I'm using is the Cambria Global Value ETF. This is put out by Meb Faber. Again, I use his research here. He does a great job of looking at the CAPE and breaking it down by country. So what the Cambria Global Value does is it invests in the 10 cheapest stock markets in the world. The ticker symbol is GVAL. But you, as an investor, might also look at individual countries that have low P&Es. iShares has a slew of them, and there's also some by Wisdom Tree. I've listed some of the tickers here, but you can go to the iShares and Wisdom Tree sites and find out exactly for yourself. So again, how do we deal with the US? Again, what I said is over the short term, anything's possible when you have a high CAPE. This chart here shows you that over a 1 year period, anything can happen, but as you start to get to the 5 or 10 year period, when you have a high CAPE value, you're going to see some negative or lower returns. The US stock market is at 25 for the CAPE, so if you look at the 5 and 10 year, for countries with CAPEs at that value, you could see a negative return over the next 5 or 10 years. So it's certainly not something you want to be fully invested in the US stock market. So how do you hedge against that? Well, if you're using longer dated bonds, that's always a good hedge. The TLT and BND will provide a hedge. And in fact, if you chart TLT compared to the S&P 500, you'd see it's almost completely negatively correlated. When one's going up, the other's going down. It's not always the case, but it's a very good hedge. If the stock market does get hit, typically you're going to see long-dated treasuries do much better as money runs from stocks to what is seen as a more conservative and safer bet in treasuries. Another interesting position could be Direction has put out an ETF, which is an S&P 500 low volatility. So it's fully invested in the S&P 500, but this is a little bit different in that it also has a trigger with the volatility index, or known as VIX. So as volatility comes to the market, and usually volatility is associated with a downturn in the market. So as volatility rises, this ETF actually starts to move some of the money out of stocks and puts it into bonds. So what you could see here, if we had another 2008, is this ETF could be as low as 20% in stocks and 80% in bonds. So what this does is it has a natural hedge for you. If the market continues to go up and does very well, you're going to be fully invested in the S&P 500. if we start to see some rough waters, this thing kind of pulls to the side a little bit. Again, it doesn't get you in at the top or in at the bottom or out at the top, but it does provide a hedge. Another thing that I've been doing for clients is using a covered call strategy. PowerShares has an ETF out there, ticker symbol PBP, and what this does is it sells covered calls on the S&P 500. So you own the stock market, and they sell monthly call options. So you're going to get the premium income from the call options. So the yield on this is going to be 1.8% from the dividend yield of the S&P 500, but you're also getting that call premium. So all in, the yield right now is over 6%. So if we have a market that stays flat, goes up slightly, or goes down, this strategy is going to give you a hedge against the market. If the market goes up 30%, you're gonna trail considerably using this covered call strategy. But based on the valuation of the U.S. market, I just don't see that happening. So that's just a quick look at some of the moves I'm making in the portfolio. Again, we want to focus on vehicles that are interest rate sensitive. I think rates are going to kind of hold where they're at, maybe even come down a little bit. We're also going to look for countries and stock markets that have a better valuation based on the CAPE. And then we're going to hedge our U.S. position with some longer term bonds and maybe even some call options or the direction ETF. So if you find this information useful, I invite you to sign up for my monthly newsletter. You'll get all kinds of information like this. I don't spam people, I only send out once a month. You can get that at my website, picketfencefinancial.com/education. You could also go to our Facebook page. Just go to Facebook and look at Picket Fence Financial, or go to YouTube, put in Kirk Kinder, and that should come up with my YouTube page. So I hope you found this information helpful, and if you have any questions, please let me know. Thank you.